So let's set the scene. It's 2009, and the world is still trying to pick up the pieces from the massive financial collapse of 2008. Fear is pretty much everywhere. But right in the middle of all that chaos, Warren Buffett and Berkshire Hathaway put on an absolute masterclass. So today, we're going to dive into their 2009 annual report to see exactly how they pulled it off, and more importantly, what it can teach all of us about investing when things get turbulent. Let's get into it.
All right, let's just start with the headline number, the big one. In a single year, Berkshire Hathaway's net worth shot up by a staggering $21.8 billion. Now look, that number is huge on its own, but it becomes truly mind-blowing when you remember the context.
And you have to remember what that context was. This wasn't some roaring bull market. This was 2009. The global economy was an absolute mess, unemployment was through the roof, and the mood was just total pessimism. So how in the world do you create that much value when pretty much everyone else is running for the hills? Okay, now this slide tells a really powerful story. Just look at 2008. The S&P 500 crashed, down a brutal 37%. Berkshire lost money too, sure, but only 9.6%. Like Buffett always says, their defense has been better than their offense. By saving so much capital during the crash, they were in the absolute perfect spot to pounce on the rebound in 2009.
So, that's the what, an incredible financial performance. But the real lesson here, the thing we really want to unpack, is the how. And it all boils down to this really clear, consistent philosophy. You could almost call it the Berkshire operating system.
First things first, they measure what actually matters. While the rest of the world is glued to daily stock prices, which, can be completely erratic, Berkshire stays focused on per-share book value. Why? Well, because it's a much more stable, even if conservative, way to track the real intrinsic value of the businesses they own. They're playing the long game, focused on the business, not the ticker.
And the engine that drives this whole machine is something called insurance float. Back in 2009, this was an incredible $62 billion. The easiest way to think about it is this. Berkshire collects all these insurance premiums today, but they might not have to pay out the actual claims for years. In the meantime, they get to invest all that money, that float, for their own benefit. It's basically a giant, long-term, interest-free loan from their customers.
So the big question is, how do they decide where to put all that capital to work? Well, a key piece of their mental toolkit comes from Charlie Munger. It's this idea of inversion. Instead of always asking, how can we be brilliant? They flip it around and ask, what are the really stupid things we absolutely have to avoid? And this slide just lays that idea out perfectly. This is what they don't do. They don't mess around with flashy businesses where the future is a total question mark. They never, ever get into a position where they need to borrow money in a panic. They always have tons of cash. And they could not care less about what Wall Street analysts think day to day. They just sidestep all the common traps that get so many other people into trouble. So now let's see what happens when you take this philosophy and put it into action in the real world. Because in 2009, Berkshire wasn't just playing defense. They took their cash, their principles, and their long-term vision, and they made a huge bet. And that bet was buying the Burlington Northern Santa Fe Railroad, BNSF. We're not talking about buying a few shares here. This was acquiring one of the biggest railroad systems in all of North America, right in the heart of all that economic fear and uncertainty. Buffett himself called it exactly what it was, an all-in wager on the economic future of the United States. I mean, talk about conviction. It was the ultimate example of being greedy when others are fearful. He knew that the country would always need to move goods, and he saw a chance to buy that essential asset when fear made the price tag really, really attractive. But, and this is just as important, 2009 wasn't only about spectacular successes. What makes these annual reports so incredibly valuable is the radical honesty about the failures. It's really a masterclass in how a company should talk to its owners. And here it is, the big fiasco. Buffett himself came up with an idea to launch a GEICO-branded credit card. His own managers at GEICO were, let's just say, not thrilled. They warned him that they'd attract the wrong kind of customers. But Buffett pushed the idea through anyway. And the result? A pre-tax loss of over $50 million, once you add up the operating losses and the hit they took selling off all the bad debt. It was a costly, totally self-inflicted mistake. And the amazing part is that he lays it all out right there in the letter for every single shareholder to see.
This quote just says everything, doesn't it? There's no corporate jargon, no blaming the economy or external factors. It's just a brutally honest and pretty funny admission of a personal screw-up. That level of accountability is the absolute bedrock of Berkshire's entire culture.
So when you put it all together, you've got the massive success of the BNSF deal on one side and the candid admission of the credit card failure on the other. What's the one big lesson we should really take away from this incredible year?
Well, it really all comes down to one single, powerful, unifying idea.
And here it is, straight from the letter itself. A climate of fear is an investor's best friend. It's so simple but so profound. While everyone else sees chaos and panic, the prepared investor sees opportunity and bargain prices. It's why having cash and a clear head is absolutely critical when the market is having a full-blown meltdown. And that brings us to this one last perfect piece of wisdom. The 2008 crisis created a downpour of opportunity. It was raining gold, and Berkshire was ready with a bucket, not a tiny thimble. That's the ultimate lesson from 2009. Prepare yourself for the storm, learn to embrace the fear in the market, and when that once-in-a-generation opportunity finally arrives, you go all in.